on, and did it catch you by surprise?
Yeah, I mean, I must say that from the way things have evolved, there is a good reason for the market to appear to have panicked. But I think what I would like to assure the market is the fact that the banking sector is sound, it's healthy, it's robust. Despite what has happened over the last few days, and I think we need to track down to the origin of the problem. One was that last year there were two cases. There was the Dubai Bank and there was the Imperial Bank. Now, those happening in close proximity to each other, so that by the end of the year, I think there was that anxiety still hanging around in the market. Then the beginning of the year, this year, banks normally have got to report their numbers by the 31st of March for the end of year numbers. And it so happens that because all of them report at the same time, the information about the non-performing loan portfolio coming out of the banking system, given the challenges that they had the previous year, are beginning to become public now. And therefore, a number of them reporting a non-performing portfolio that is more elevated than it was last year. I think that tends to create a general panic in the market. But the critical thing is the fact that it arose out of the economic environment that was happening in the previous year, and it's not something that is systemic across the whole sector.
Thank you, Habil, and I appreciate the fact that we do, as want to maintain some sort of calm within the sector. But my most important question within the question that I asked you was, why are you surprised by what has been happening?
To an extent, I can't say that I was expecting that kind of thing, but generally I was expecting a lower performance in 2015 compared to 2014. So I was expecting the numbers come out from the banking sector. Overall, I was expecting a lower performance.
How about the cooking of the books, or the alleged cooking of the books?
Now, those are isolated cases. Like, for example, I think you might talk about recently there have been the two cases. There's the case of National Bank, and then there's recently the one that appeared recently in the papers, the one of Chase Bank. And I think if you look at the nature of the happening in the two cases, they are very unique and specific to the bank itself. If you look at what happened at Chase Bank today, it was clearly a case where the details have not come out, but it's a case where there was a statement of numbers, and the numbers, by virtue of that, some director and the CEO and the chairman seems to have been involved, and therefore they stepped down. So it is something that is specific to the institution and is being handled at the institutional level, and it's not something that is systemic to the whole industry.
All right. And of course, in a moment, we'll delve into the industry and the different members that you have and the loopholes. And I'd like to bring you in, Okundi. At this point, it is becoming increasingly clear that banks are getting extraordinary latitude, to underreport and to use this nice words that Olaka has used. Well, Kenyans would say we're being robbed outrightly. And I just want to find out from you, where are the loopholes?
I think, Terian, several factors come into play here. I think one, there is pressure to perform by the banks, and indeed by any other corporate entity. So at times, the shareholders will want to see good results. The management will want to report good results for various reasons. So I think the pressure to perform and therefore show good numbers is a driving factor. And to me, it all boils down to corporate governance, whereby it starts with the management as the first line to observe the corporate governance good principles. Then it goes to the board, and then to the auditors, the external auditors. So I think if we are able to instill good corporate governance practices in the banking sector, not just banking sector, but in all the businesses that we are in, we are likely to see a number of these cases going down, because corporate governance will ensure that internal controls are all looked into, and the numbers are reported that reflect the actual business, the actual results of the business that we are looking into.
And I would like to come back to corporate governance in just a moment, but one of the issues that Kenyans are asking about is, is our money safe? And I know that you have mentioned that these are isolated cases, but we know when it comes to money, we want our money to be safe. And it is becoming increasingly difficult to believe the financial health of banks. What can you tell us about that, given that you're the umbrella body for the banks?
You know, one of the things is that given the information age we are in right now, the information travels pretty fast. Social media is very active, and we have seen information, you know, almost like real time happening on the social media. But the only caution is the fact that part of that information is not true. It's false, and when it spreads so fast and is unverified and is inaccurate, that can cause quite a bit of panic in the market. We saw it, for example, last year when the case of the Imperial Bank came up, where there was a list that was circulating on social media of banks that were apparently being targeted as the next in line after Imperial Bank, which was completely false. They listed the reason out of something totally different. We saw something similar again today and yesterday about Chase Bank. You know, information, because some information has come up, there's a lot of build-up and inaccuracies that go around to portray that information like as if it's the truth. You know, so in a way then it tends to create the wrong impression about the industry in the perception of the consumer. And this is the kind of thing that we would want to assure the public, that such information should ordinarily be verified, and therefore KBA, for example, is very forthcoming in terms of providing the right information to the market, especially on such developments. All
right, if I may use your words, Mr. Laka, you talk about isolated cases, and of course the banks, you know, that the list of the I think Tier 2 and Tier 3 banks that were released last year as being targeted for shutdown was an unfair case, so to speak. But in the same case, Imperial Bank, Chase Bank, we started hearing about this, you know, on WhatsApp, on Twitter, and it sort of seems that where there is smoke, there is fire. And my question to you is, shouldn't there be, you know, the regulator or somebody to be able to manage this information early enough and to manage the situation and talk to their customers and the consumers so that they do not panic, because that seems clearly there's somebody who's not doing their work?
Yeah, I think the critical thing is the fact that it needs to be a combined effort. The banks are trying their level best to communicate the right information. If you saw today in social media and even the main media, there was quite a bit of an attempt to get the right information out there. But when there is parallel information that is coming in through the social media and being turned around to give a negative picture, and especially if that information is also picked by the mainstream media and amplified when it's not accurate, then we have got a challenging role to play where we are trying to counter information that is already out there and negative. So even if you come up with positive information or the accurate information, it's still being countered by the negative information that is out there. So I think my message would be the fact that I'm trying to rely on verified information rather than information that is just floating around in the social media especially. Yeah.
But what is the way forward? And I know that in developed markets, especially around about the time Barclays PLC had issues there was an argument about focus on policy other than just such a strong focus on supervision. And I'm wondering, perhaps we can take you up on the Okundi, policy versus supervision. Where is the weakness and where should the focus begin in the local scene?
Thanks, Terry. And I think it's fair to say that we've seen significant developments in the prudential guidelines issued by the Central Bank of Kenya to govern the operations of the banks. Now, these guidelines are meant to instill some discipline in the way in which the bank's business actually being run. So it's a question of enforcement of those guidelines and ensuring that they're actually taken into significant practice on a daily basis. In particular, I think there's now a very strict requirement that the directors of the bank must be independent in not just being non-executive, but independent in the sense that they must not be shareholders. So that basically eliminates the aspect of the conflict of interest, which can result into the banks wanting to report better results than what actually reflects the situation on the ground. But also it's fair to say, because of the developments in the banking sector, it's the capacity of the supervisory body, that's the Central Bank of Kenya, also need to be enhanced. I must say that there's been quite significant activity for the last couple of months in the supervision, and we expect to see that much happening. So if that is strengthened on a continuous basis, then obviously most of these issues will be identified well in advance to avoid any panic in the sector.
Habil, there are allegations that the regulator has been compromised in the past, and I'm just wondering, and based on the people that that we're speaking with on the ground, some say, does CBK have, one, the moral authority to deal with this once and for all, and two, do they have the capacity to actually do it?
And those are really valid points of discussion. One is the authority to talk about it in the first place. I think one of the things is that when the new central bank governor, Dr. Patrick Njoroge, was appointed, one of the things that he clearly mentioned was the fact that he's going to focus on strengthening the supervision department of the bank, and he has gone ahead and done that. And so now the supervisory arm of central bank is really getting strengthened, and you can see the impact by virtue of the fact that they are now making the on-site visits and the off-site inspection of the financial institutions, and the results are becoming quite clear. Banks are now being put on their alert to ensure that they comply with the regulations, they comply with the law. Corporate governance structures are up to scratch. They follow the credit policies. They do the proper classification of the portfolio, do the provisioning and all that. So I think to that extent we can say that they have actually got the moral authority to talk about the health of the banking sector. You talked about the capacity, and as I mentioned, I think since the governor came into place, he has really focused on ensuring that he builds up the capacity of the supervision function of the bank to be sure that they can play its due role.
Let's talk about competition and how this is driving cooking of books, so to speak, or under-reporting or over-reporting, whichever the case may be. What are your thoughts around how that situation, can be dealt with? Because the competition is not going away anytime soon.
Yeah, I think the pressure to perform it is there, and will always be there for various reasons. But what is most important is that the books of accounts need to reflect the actual status operations of the bank or of any entity. So they need to be ethical conduct of the business. Those who are in charge of preparing books of accounts, governance, need to have that ethical conduct in the way in which those books are actually reported. But I think the profession has gone ahead and sort of tried to curb this menace. For example, the financial reporting standard that deals with the banks, IFRS 9 in particular, now has come out much more aggressive in the provisions of loans, such that non-performing loans, such that because that has been a significant area where the books have not been has not reflected the actual situation on the ground. So with the implementation of that beginning 2018, we are likely to see much more sanity around that area. At the same time, the audit report that the auditors normally issue, which basically express the opinion on the financial statements, is going to be enhanced, such that it will not just be an opinion on the set of the financial statements, but there will be key audit matters that will be covered in that particular report, so that the shareholders and the users of those financial statements can clearly see other issues that would have come to the attention of the auditor in carrying out the audit. So I think a combination of the reaction of the profession to ensure that the issues that affect the banking industry are dealt with in a much more proactive way, together with good practices by the individuals that are responsible for the governance, should be able to address this issue. The first line of defense obviously is the management, because they are there on a daily basis. They should be able to ensure that the business is done in a much more sober manner, followed by the board, of course, and then the internal auditors, who must actually be independent. The chair of the internal audit committee, the chief internal auditor, must report directly to the chair of the internal audit committee, because the management relies on them heavily as a second line of defense.
What does it say about the auditors, though, both internal and external?
I think they've got a key role to play, and the critical thing there is really the independence. We also have the supervisors from central bank, who also play an additional role of ensuring that there's an independent evaluation of the processes. I think the internal audit, external auditors, and the bank supervision all combine to give that oversight over the activities of the financial institutions, to ensure that the reporting, for example, is, as Benson has said, reflecting the true situation on the ground. You see, if you look at what happened in Kenya, for example, towards the second half of last year, it was a very challenging period for the not just for the banking sector, but for the whole economy. What then tends to happen is that there's intense competition to go for the facilities, for the customers that are available, and obviously with that intense competition, eventually, and given that the rates, for example, had gone up, there's bound to be a tendency of the non-performing loan portfolio to basically grow. Now, the temptation to understate the non-performing portfolio is there. The temptation to not provide adequately for the non-performing portfolio is there, and therefore we require the independent auditors, the internal auditor, the independent external auditor, the independent supervision from central bank to ensure that that tendency is not picked up.
All right. We're winding up now. I want to ask one last question, and I would want responses from both of you. Now, today the central bank governor said 80% of liquidity in the country is held by just 8 banks. And coming off a report by Cyton Investments yesterday, and they were saying, Kenya is overbanked. We've got 42 banks against a population of 44 million people. If you look at the situation in Nigeria, they've got 22 banks with 180 million people, and South Africa, which has 19 banks against 50 million people. Could that be where the problem is? And does this present a case for consolidation from a regulatory perspective?
Yeah, I think it's important to consolidate the sector, and therefore a move to sort of merge the small banks that are in operation should be in the right direction. However, we must also recognize that our banking sector has contributed significantly to the development of the economy for the last 10 years, or for the last several years actually, and therefore the gains that we are having today are as a result of some of those developments. But as we look into the future, and also with the line to the good practices, I think consolidation of the sector would actually be helpful.
Habil, as you wind up?
Well, I think I've got a little bit of a different view in terms of the consolidation, because at the end of the day, consolidation to achieve what? If it's to achieve economic growth, if it's to achieve financial inclusion, the examples that are normally mentioned is, for example, in Nigeria and South Africa. And I think the circumstances of the three economies, Kenya, Nigeria and South Africa, are very different. In Kenya, for example, in terms of financial inclusion, we have gone miles away from what is achieved in Nigeria and also achieved in South Africa. We are miles ahead. South Africa could be a little bit better than us in terms of growth of credit as a proportion of the GDP. But clearly what I'm trying to show is the fact that there's no standard number of how many banks you should have per a given level of population or per a given level of GDP. So it's a matter of us in Kenya developing our own model, and I think currently the way we are progressing in terms of financial inclusion, we are possibly on the right path, and we have been able to achieve this with the number of banks that we have. If there is anything, I think the challenge we have is that to be able to achieve financial inclusion up to the rural areas, we possibly need more players to get into that up to that level.
All right, thank you so much. Habil Olaka, CEO, Kenya Bankers Association, and Benson Okundi, partner, PwC. Thank you so much for your insights into Kenya's banking sector. We're taking a short break now, and when we return, we've got Smart Farm and property insights, as well as a look at more business stories. Don't go too far.